Hey, what's up, stock compounders? Brad here. It has been a while since I've made a video and I have missed you guys. So today I want to reveal my wish list. What stocks, what businesses would I love to own, and at what price would I love to own them? But first, I want to set this whole thing up by kind of talking about where we are in the market and why I think now is a great time to really get your wish list in order and your target buy prices. So, where are we? So, Warren Buffett, one of his favorite ways to look at where we are in the stock market is a thing called the Buffett indicator, which is the Wilshire 5000 over the GDP of the US. Okay. It's essentially, the 5,000 largest US companies. Divided by what is the country producing? What's the gross domestic product of the country? So the value of the businesses over what are we producing as a country, and he thinks that's a great indicator for whether prices are kind of overvalued in the stock market, whether they're undervalued, where we're at. So you can see here we're looking from 1970 to 2020. Okay. We are the highest in terms of the Buffett indicator that we've ever been since this period started in 1970. 160%. Okay, guys. So, this is not to say the market is going to crash tomorrow. But as Howard Marks would say, there are times to be cautious and there are times to be greedy, right? Now would be a time for caution, all right? So this is one data point to reflect that. Another data point is the Shiller price to earnings ratio, the price to earnings ratio of the S&P 500, essentially as a whole. So if we look here, this is great. It goes back to about 1870, all right? Looking at, the Shiller PE. So you can see, Black Tuesday, the start of the Great Depression, we hit about 30 on the Shiller PE. We've gotten over where we are now once before, and that was the tech bubble, okay, of 2000. So guys, we are, according to these two measures, which are really solid measures for where we're at in the stock market, we are pretty much off the charts in terms of the market as a whole being overvalued, okay? And then, of course, this third data point here. You probably all remember back in March, Bill Ackman placed a bet that corporate debts were going to start defaulting, right? Businesses were going to be unable to make the interest payments on their debts. And he was right back in March. In fact, it was one of the best, most incredible trades of all time. I think within the first month that he was paying premiums on this credit default swap, it paid off, right? So he pays $27 million for the first month, and then boom, he gets $2.6 billion for this bet. So the timing was incredible. But just recently, earlier in November, Bill Ackman placed the same bet, right? He thinks, coming in, not necessarily that he thinks, he's hedging, right? He's hedging against the market tanking because obviously he's very exposed to stocks, right? To equities. So he wants to protect his portfolio plunging by making a bet that'll pay off if that does in fact happen. And he's nervous. He's obviously nervous because we're heading into flu season, right? We can already see cases starting to trend upward. We have a new president at the helm, which tends to make markets, there's uncertainty, right? Investors do not like uncertainty. So, there's just a number of things kind of coming down the pike here where Bill Ackman, wants to make sure that his downside is protected. So he's placing this same bet that he did back in March. So given all that, right, guys? Given all that, it's a great time. We want to be prepared. If the market tanks, we want to know, we want to do the work ahead of time. What do we want to buy? And at what price do we want to own these businesses? So, be greedy when others are fearful. Shoot for the moon, guys. Identify the businesses that you really want to own, businesses that you haven't been able to own because they've always been too expensive, okay? So this wish list is primarily composed of businesses, great businesses that everyone knows are great, that are usually too expensive. So let's take a look at what these are. So here's my wish list. 9 companies. We've got Facebook, Alibaba, Berkshire Hathaway, Visa, Micron, Costco, Google, Moodys, and Seritage Growth Properties. Okay. Now this is a very important column. These are my buy prices. So if the price comes down for Facebook to 230, I'm going to be buying. Now, I'm not necessarily going to be buying an entire 10% stake all at once. I'm probably going to be tranching into these things. So, first I'll put maybe 2.5% in at 230. If it comes down another 10%, so down to 207, I'll buy another 2.5% stake, and I'll kind of follow it down. Okay. So that's my plan there. And I'm going to kind of deconstruct how I came up with these buy prices. But of course, this column, you've got the current price. These are the prices I pulled November 24th, which is the day I'm filming this. And then we've got the delta. How close is my buy price to the price today? And I sorted these by delta, right? How wide is the spread there? So Facebook, I'm closest to pulling the trigger on out of these 9 companies. So these 2 columns are kind of how I determine the buy price. The first one is a margin of safety valuation, and I'm using the method that Phil Town uses. Okay, so we're looking at the trailing 12 months earnings per share. I'm going to pull this. I'm going to pull up the numbers that I use to kind of calculate these things. So for Facebook, earnings per share, we're going to grow that earnings per share over the next 10 years by some growth rate. And the growth rate I'm using for Facebook is 14%. It's really up to you how you determine what growth rate you want to use. So 14%. And then at the end of 10 years, we need a price to earnings ratio that we're going to use to convert that future earnings per share into a future share price. And I'm using 28 for my future price to earnings ratio. And then, of course, we got to discount all of that back to today. And I'm using a 15% annual discount rate, which is what Phil Town recommends. We don't even want to be looking at investments in the stock market if we're not going to be able to earn 15%. That's kind of our minimum acceptable rate of return. And then normally what Phil Town would do is he would take half of that kind of fair value, okay? I'm not doing that. I'm just leaving it at the fair value. And the reason for that is I know that these are great businesses. At least the ones where I'm using this margin of safety value. I know that these are great businesses. That applies, it applies to Facebook, Berkshire Hathaway, Visa, Costco, Google, Moodys. I know that those are great businesses. So I'm comfortable using fair value for a margin of safety. Now, I didn't do that with all of these. The other column here is equally, if not more important. So what I did here is, for Facebook example, I'm looking at what investors that I really like, I know they're great investors. Which ones own Facebook, okay? And which ones own the biggest chunk of Facebook, right? They have the largest allocation of Facebook in their portfolio. So let's take a quick look at that. It's quite easy to find. So I go to Data Roma, type in FB, and I can see who owns Facebook. So Li Lu, probably my favorite investor, okay? My favorite investor to clone. I have so much respect for Li Lu. You can see he more than doubled his position in Facebook in the third quarter of 2020. So what I did, quite simply, is I looked at what was the low price in the third quarter of 2020. And it was 230. And I'm assuming Li Lu is so good at investing that he was able to nab that low price for the addition of Facebook to his portfolio. I'm sure he didn't get it all at 230. He probably got it higher than 230. But if I assume he got it at 230, I'm building in a little extra margin of safety into this process here. So I'm assuming he got it at the low in quarter three. And that's my target buy price, guys. It is as simple as that. And you can see the target buy price based on where Li Lu bought in the third quarter. It's very close to that margin of safety valuation, which is great. Those two data points are very aligned, which gives me kind of an extra degree of confidence in this buy price. So, that's the one I'm closest to pulling the trigger on. Hopefully it comes down a bit over the next couple of months so I can own Facebook. I would love to own Facebook. Moving down the list here, Alibaba. So Ray Dalio in quarter three added a significant stake in his Alibaba position through Bridgewater Associates. You can see that if you just check out the 13F filing for Bridgewater, or you go to Whale Wisdom. He's not in Data Roma, but there's plenty of sites to see that recent addition of Alibaba. Now, the low in quarter three for Alibaba was $216 per ADS, right? American Depository Receipt, which is basically like a share, but it's a Chinese company, so you can't buy shares directly through U.S. exchanges. You have to buy the ADR. Sorry, not ADS, ADR. So I calculated the margin of safety value, and I got $288. Now, I used a pretty aggressive growth rate for Alibaba. I used 16.3%. You might not think that's aggressive based on what Alibaba has done in the past. But it's aggressive for me. I really don't like to use more than a 15% growth rate for the next 10 years, especially when I'm starting with a company that's as big as Alibaba, a market cap in the 800 billions. It's a big company. Obviously, China is a very big market as well. So since the margin of safety value is quite a bit higher than the guru price, I decided to go with the guru price. Because I did use a fairly high growth rate, and it's a company in China, right? And there's obviously concerns about the government kind of clamping down on the growth of Alibaba. Obviously, the Ant IPO was suspended. So there's some hair. There's some hair on Alibaba. There's a bit of uncertainty about what the company is going to be doing in 10 years. So I'm going with this more conservative kind of guru-based price of $216 for my buy price. Berkshire Hathaway. So the price today, you can't really use traditional discounted cash flow valuations for Berkshire because it's a holding company. They've got both public equity investments and private holdings. It's complicated. So the simplest way to value Berkshire Hathaway, which I picked up from another smart investor, is 1.3 times book value tends to be a good proxy for what the value of Berkshire Hathaway is. And that's about where we're at today, at $234 per share. Of course, I don't want to pay fair price for Berkshire Hathaway. So I looked at, where did Buffett likely load up on Berkshire Hathaway in quarter three? I think Berkshire spent about $9 billion on share buybacks, and the low price in quarter three, you can see a pattern here, was $178 per share. I believe that was like July 1st or something, right at the beginning of the third quarter. So that's my target buy price, $178. Very simple. You can see we're about 31% off from that now. We've got Visa, which was bought by Chris Hone, who's an investor that I follow. TCI Fund Management is managed by Chris Hone. He was buying potentially as low as $136. I believe that was in the second quarter of 2020. I came up with a margin of safety value based on earnings per share, based on growth rate, based on future price to earnings ratio, came up with $157. So, I decided to use $157 for my buy price for Visa based on this margin of safety valuation. Yeah, I want to own Visa. I know it's a great business, and I think $157 is a fair price to pay for it. Again, a company I would be tranching down on if it does reach that point. Micron is a business that I own. It's a fair chunk of my portfolio. I bought in actually around $35 back when I saw Pabrai was first buying it. It's gone up a lot since then. It's at around $64 per share. You can't really do a margin of safety valuation on it because it's a cyclical business, and we're kind of at the trough, many investors believe, of that cycle. So if we were to use the last 12 months earnings per share, it would just be, it wouldn't really make sense valuing the company that way. So I'm really anchoring to kind of the guru's recent buy price of Micron. And both Li Lu and David Tepper, I believe they both added Micron in the third quarter at around $43 was the low in the third quarter. So that's my target. I'll probably add more if it gets down to $43 per share. We've got Costco. Now, Costco is interesting. Charlie Munger owns Costco in his personal portfolio. It's one of the three companies that Charlie Munger owns in his kind of family portfolio. Not companies. He owns Costco, he owns Berkshire Hathaway, and he has a chunk with Li Lu's fund, Himalaya. So, I know Costco's a great business. I shop at Costco. The deals are incredible. And I love their recurring revenue business model of charging annually for memberships. It just makes a ton of sense to me. Now, there aren't really any super investors who have bought a significant stake in Costco recently. This guy Bloomstrand, who I think he runs Semper Augustus, which is a fund. I went back 6 years through his 13F filings, and there was essentially no buys of Costco for the last 6 years. And Costco is only 3% of his fund. So I think the deal with Costco is it just hasn't been cheap enough in the last 6+ years for any of these super investors to be interested in it. I mean, we all know it's a great business. It's just crushed it during this pandemic, as people have been stocking up on food and whatnot. But there's no great cloning. There's no great investors to clone to try to figure out, okay, what's a good entry price for Costco? So I did a margin of safety valuation. I came up with $251 per share. So that's my buy price. That's where I'll be entering Costco if it gets down to that point. Obviously, it has to come down quite a bit from where it's at now, more than 50% to get to that target buy price. Google. Now, there have been some awesome investors who have been buying Google lately. Lee Lu has been buying Google, Seth Klarman, Michael Burry, and many more. Google and Facebook are probably the two hottest businesses right now for super investors. I shouldn't say right now, within the last year, okay? Within 2020, really. You can see it's risen a lot because back in March, it was below 1100, okay? And now we're in the mid 1750s here. So Lee Lu bought Google in the second quarter. And so that's the guru buy price that I'm anchoring to, 1098, the low in the second quarter. Margin of safety valuation that I did for Google, very close to that buy price for Lee Lu. So, I bumped it up a little bit to the margin of safety value at 1125. I'd love to get in to Google at 1125. Obviously, you're watching this on YouTube, which is a Google product. So, I understand at least YouTube. There are many Google products and many that aren't even monetized, which could be monetized. I know there was a bit of controversy when Google announced that they were going to potentially start putting ads on YouTuber channels that didn't meet that monetization threshold, and they weren't going to be sharing that revenue with those content creators. So, yeah, I question that move myself, but I think they're just testing it. They're just piloting it, so it's not even clear if they're going to roll it out on a massive scale yet. But anyway, would love to own Google at 1125. Moodys is a business, Pabrai talked about Moodys in a few of his lectures. It's interesting to look at what happened to Moodys through, the financial crisis in 2008. Moodys was really one of the big causes of that crisis. They were giving these great ratings to these instruments, these credit default swaps that deserved to be rated terribly. They were clearly unsafe, right? And yet Moodys was just saying, oh yeah, that's fine. That's we're giving it a great grade. I don't think they really understood what these things were that they were giving great grades to. And even, despite all of that, sure, they went down during the financial crisis like everyone else, but they bounced back stronger than ever. So, not even the disaster of the financial crisis could blow up Moodys. That's how resilient of a business it is. So, I would love to own Moodys. Similar situation to Costco. There's really not a lot of recent buying of Moodys from super investors. Chuck Aker, I think he owns more than a 10%. Moodys is more than 10% of his portfolio, but he hasn't bought it since the beginning of 2017, when it was $97 per share. So, I'm going with my margin of safety valuation on this one, $165, which it's got a long way to come down before it gets there. But we've seen crazier things. So, I think it's still relevant to have it on here because who knows what we're going to see in the next couple of months. Want to be prepared. And then the last one here, Seritage Growth Properties. This is a company I bought after seeing that Pabrai had bought more than a 10% stake. So he had to file a specific filing with the SEC that you need to file if it's if you own more than 10% of the business. And he bought, I think the low this year got into the five and change dollars per share. I'm assuming his average was around $7 per share, based on the range of prices in the second quarter when he was buying. Current price today, $18.20. Of course, I've made some videos in the past about Seritage Growth Properties. I took a decent sized position at around $10 per share after doing a little bit of digging into the business. Phil Town is also pretty bullish on the company. He thinks it's going to $140 per share, in 10 years from now. So, I'm pretty happy with my stake. If it gets down to $7 again, probably add a bit more, since I bought at 10. But, obviously it's got to come down quite a bit for me to buy more. Although, it's not crazy, guys. I mean, Seritage Growth Properties is a very volatile stock because, the company isn't really earning any money right now. And they're putting money into redevelopment. They've got, $1.6 billion in debt, which is significantly higher than the current market cap of the company. I think it's like 3 times, maybe a little bit less than 3 times now that the price has gone up quite a bit recently. But, it's one of those kind of long-term bets. It's going to take a while for that business to play out, and there's definitely risk. So not a 6-inch bar, as Phil Town would say. But these are currently the 9 businesses that I'm watching, and the prices that I'm intending to start buying into them. If Mr. Market decides to throw me those prices, and I think it's very possible. I'm not a market forecaster. I don't know what's going to happen in the next 3, 6, 12 months. But based on these factors that I laid out with the Buffett indicator, the Shiller PE, activity from Ackman, kind of shorting credit, anything is possible, guys. Obviously, we've seen in 2020, just how 2020 has played out so far, that anything is possible. So I'm going to be ready with my stock wish list. I encourage you guys to be ready as well. And I'm curious to hear from you. What's on your wish list? And if you have any of these companies on your wish list, what are your target buy prices? And I'd be curious to hear from some of you, how you justify those prices. Anyway, guys, that's all I got for today. Thanks for tuning in, and I hope to see you guys very soon. I don't want to go another 5 days without making a video, so hope to be back very soon. Anyway, see you guys.